Well, hey, Pat, I'm pretty excited. I don't think you didn't meet Apollo before, had you?
I did not.
Okay, so our next guest is a really interesting guy. His name is Apollo Lupescu. He's known as in our industry, the Secretary of Explaining Stuff.
I've listened to some of his material before. He takes really complex subject matter and makes it digestible. Is what I got out of it.
Well, and I think, sometimes people tell us they like this about the show because we're able to do that, but I think he does it even better. So we've had him speak at our conferences. We've had him, I was actually spent an afternoon with him in their studios in Austin, Texas, which meant some of you might have seen some of the material on our website, which you can still find today if you go searching for it. But Apollo Lupescu is Vice President at Dimensional Fund Advisors, which is a good shop. They're really interesting firm, and a lot of our advisors use their funds. But he's just world-renowned investment manager. Like I said, he's the Secretary of Explaining Stuff, and he really presents around the world. He speaks at some of our conferences. As a matter of fact, I think he was out at a client event just recently.
Yeah, in the San Francisco Bay Area, and I think in our Santa Fe office.
I didn't know we had a Santa Fe
Albuquerque.
Okay.
Albuquerque.
Apollo, thanks for taking some time to be with us today.
Hey, Scott. Hey, Pat. Great to talk to you, and thank you so much for the invitation. And indeed, I just came back from San Jose. It was a packed house, and a couple of weeks before that, it was indeed Albuquerque. You guys are all over the place.
So I noticed you are a PhD, so you should be the doctor of explaining stuff. And real quickly, how is it that you've come to this place where you are this expert at explaining stuff, and that's kind of your role?
Yeah, and what's the PhD in? What's the doctorate?
So PhD is actually in economics, and it was an emphasis on finance and investments. And I just really got enthralled with sort of the mystery of the stock market from my undergrad years, and I wanted to really try to understand it better. And I followed up all the way through the PhD. And I got to learn sort of the underpinnings of the theory. And then I was fortunate enough to connect with this company, Dimensional, because a lot of the papers that I used to teach and I was being taught came from the academic world. And a lot of these academics were actually affiliated with Dimensional. 5 of them actually were awarded the Nobel Prize in economics, and to me, that alignment was quite crazy. that I was able to find this almost the cross-fertilization between the academic world and the practical world of investing. And as I start talking to individual investors, what I found is that a lot of these theories are really, really interesting and really useful. It's just not easy to understand. And the moment to me, Pat, came when I was talking to some friends about my dad, and he had some issues with the pancreas. And I knew it's in my body somewhere. I knew it does something, but I wasn't exactly sure where and what it does. And it occurred to me that might be nice if I knew that, but it's not my job to know those terms, the jargon and everything that is related to the technical aspects of a profession. And then I thought, if I'm not really supposed to know what the pancreas does, why should I expect somebody else to understand all the jargon and everything that we're familiar with in the industry, but not necessarily in the public domain of knowledge?
Thank you. Thank you. Right? I've had the same interaction in medicine, and I've actually I had a daughter that was very, very ill, and I actually had to say to the doctors, okay, I'm in the 3rd grade. Talk to me now. Yep. Right? We're asking them, like, you're going to have to...
most of them aren't really trained. These specialists aren't trained to communicate with patients.
Especially if there's 4 of them. And I just remember 4 of them talking together, and I was in part of the conversation, and they pretended like I was supposed to know, right? And I had no ego in it, which allowed me to say... I'm in the 3rd grade. Talk to me like I'm in the 3rd grade. But can you imagine what the average investor, which by the way is why all the sound bites on the television is they get the guy that, for the financial news that can squawk the loudest and say,
whatever's controversial.
Yeah, that Kramer where they had the bing bang boom thing, Jim Kramer, exactly. Right? Which I thought was
entertaining.
Was ridiculous. Anyway, so I appreciate what you do.
Yeah, and you're really all about separating data and evidence from emotion, right? We talk about that a lot on the program, and here it is. presidential election coming up here pretty soon. What's this like with the markets? Because I'm sure people talk to you, like we have clients that are getting nervous that Harris is going to win, nervous that Trump is going to win. Oh my gosh, what do I do with my portfolio? What happens if Trump gets in? What happens if Harris gets in? So, like, how do you think people should be thinking about this?
Yeah, it's a great place because talking to your clients across the country, what I found is that there is anxiety on either side.
That's
it's
right.
not limited to one side. As you said, if one group of constituents might be concerned that what if we have an autocrat coming in the White House and democracy doesn't hold up as well, we have another group that say, what if we have a communist coming in the White House and all of a sudden the government starts barging in and taxes go up, whatever the case might be. So I think that there is anxiety on both sides, and I think everybody's affected by this. And the reason for this anxiety, in my opinion, is because politics and emotions, they tend to touch our deeply held beliefs, our core identity as individuals. And because of that, they trigger these very strong emotions. And Scott, what I have to say is that it is perfectly fine to have these emotions, because that's what makes us human, having these emotions. And it's also okay to act upon those emotions. And probably the best way to do is a vote. I mean, we're lucky enough to be in a free country that you can go and express your feelings by voting. And it's so sad that so many people don't do that. But if you have that strong emotion, if you have that anxiety, well, go vote for whatever makes you feel comfortable. What I also found over the years is that the most successful investors are able to acknowledge these emotions and honor them and don't feel bad about them. And at the same time, disentangle them from investment decisions and make those decisions much more based on data and evidence. Be very pragmatic when you deal with your money and make those decisions based on much more rigorous analysis that involves numbers. And, in the stock market in particular, it's quite interesting because stock market, by the way, talk about translation and simplifying. I find that those words quite often have a bad connotation that I have no idea. It's a mystery out there, and Wall Street's taking advantage of me and all this stuff.
It's a big casino.
I actually think that Wall Street and the stock market and all that, that's not really what this is. If I were to reframe the stock market and call it something else, I would say it would be an ownership market, where you and I and everybody on this who's listening to this podcast can go buy and sell ownership in companies they did not start. And that's what the market is doing, is being very unemotional, very pragmatic, and asking a very fundamental question. How will a presidential candidate who might become president, how will they impact the profits of any one company? Because that's what is ultimately driving the stock market, the profits and the earnings of every single company. And that's what the market's trying to address, not the emotional side about reproductive rights, not about, how do we feel about books being allowed or not allowed in libraries. That's irrelevant to the market. What they want to know is, what about profits? How will a candidate impact earnings and profits for any one company out there?
And then what about for different sectors of the marketplace, or segments, like different industries? Like one, like I'm thinking about, if one of the particular candidates gets in, maybe that's better for green energy versus the other one might be better for coal.
Absolutely.
For coal,
and that is, and I have to say, it's a very legitimate way to look at it. And I would say that absolutely, there will be an impact on different sectors based on who is coming in. So there's no doubt that is going to be the case. What I also found interesting is that there are two things that you ought to consider as an investor. The first one is that this ownership market that I talked about, also called the stock market, it tends to be incredibly competitive. Because when you buy and sell ownership, you're not buying and selling from the company itself as much as you are from other investors. So you're competing with other investors. So there's a lot of competition, particularly when it comes to information and forming an expectation about how these policies might impact the earnings of the company. And what we found over and over and over again are two things that are hugely important for investors to know. The number one is that because this ownership market is so competitive, any expectation of an industry benefiting or not benefiting tends to be very quickly reflected in the price of that particular company or that particular sector. So if I expect that one particular sector is going to benefit, and I do have a good expectation that perhaps one candidate might win in that respect, then those prices for those companies, they tend to adjust incredibly quickly. So by the time you get around to buying them, sometimes it could be a matter of seconds and even less that these expectations actually get incorporated today with the way that information travels into prices of companies and stocks. So I think that you have to be very careful because a sector might benefit, yet by the time you buy it, it might already be priced in, so you're buying it at a higher price and might or might not be a good deal. But the second thing that I think is hugely important is that it is not about the sector itself. And I think in general, the market shouldn't be thought about as the market as a whole, but it's much more about individual companies. Because when it comes to earnings and profits, it's not all about what the government does. And guys, let me tell you two case studies that I found quite interesting. One pertains to the previous administration. And during the early days of the Trump administration, there was a big push that they were making to encourage domestic manufacturing. And at some point, they start talking about the steel industry. And they said, well, we need to promote the steel industry. And at the time, there wasn't exactly a clarity of how I might do it, but there was an expectation that the administration will do something to help out the steel industry. And if you look at the price per share of the company that carries the name of that industry, it's called U.S. Steel. From January, it was dropped a little bit, and then the talk came about, and perhaps the expectation of something to be done to help the industry. And then all of a sudden, the stock price started going up. And in March of 2018, in fact, steel tariffs were imposed on foreign producers, which meant that U.S. Steel had a huge leg up, and that gave them a big competitive advantage in the U.S. market. So at that point, if you're an investor, again, it's that seductive narrative. Look, the U.S. government got behind the U.S. Steel. This has got to be good. So I better go and buy some of that stock. The problem was that if you look at the price per share from the time when the tariffs were announced to the end of the previous administration in the election of 2020, what you see is that U.S. Steel lost the majority of its value. It would have been devastating for an investor if they followed that seductive narrative. So just because the U.S. government got behind it, it doesn't mean necessarily that that's going to be good.
Well,
Why?
I'd say,
well, because it's also about the strategy, the product, the service to customers, implementation, what competitors do. So there are a lot of other factors.
I'd say Intel is a current example, right? So with the CHIPS Act, Intel's half the value as it was a couple of years ago.
Absolutely. And it's looking at a buyout right now.
Yeah, right.
Now, the current administration has, somebody mentioned green energy. And I think let's take a quick peek at that, because if you look at green energy and you say, well, this is a sector that's going to benefit, one of the primary tools that the green energy is trying to bring to consumers is solar energy. And I think it's a phenomenal energy. And in fact, back in 2021, I was looking at solar panels, and I remember that I had some companies that I was comparing prices. And recently, just about a few weeks ago, I wanted to see, would this push in green energy, how do these companies do from an investment perspective? And, I'm going to name some companies just not to say they're good or bad or investment advice, or you should buy them or not buy them. But what's interesting is that if you look at one of the companies called First Solar, over the course of the past 3.5 years to the end of August or so, it pretty much more than doubled in value. So you would have doubled your money in 3.5 years in this solar panel company, which might be an indication that is a strategy that made sense. Maybe I should have put money in there. Now, at the same time, in January of 2021, I remember comparing prices, and another company that I looked at was called Sunrun. And Sunrun was trading roughly the same price as First Solar. And what's interesting is that by the end of August, pretty much the same time as First Solar, instead of gaining twice and doubling in price, Sunrun lost roughly about 75% of its value. Same industry, same benefits they might have had from whatever energy push was made by the administration. And to me, that's a bit of a validation of the second point, that it's not about the industry as a whole. You have to look at the company. And what was fascinating as I looked into these, there were quite a few analysts back in 2021 who were suggesting, by the way, Sunrun is the way to go. Go buy Sunrun, forget about First Solar. They're kind of placing exactly the opposite bet. So the point that I'm making is that it's a seductive narrative. I just think the actual driver of companies' profits, it just goes well beyond the government policy, and it has to do with their products, their strategy, the execution, competitors, so many other things. And because of that, I don't believe that investors ought to place these bets on sectors just because they might hear, well, the government's going to get behind it. I don't know that that's in fact, I'm quite convinced that is not the right way to go.
And so November 6th, we'll know we'll know sometime weeks after, whatever it is anymore. But there'll be one of the parties is going to be in the White House. One of the parties is going to control the Senate. One of the parties is going to control the House. From an investor standpoint, looking at like historical data, what tends to do better? So if I can care less about anything else going on, whether it's books in school or whatever the cultural war stuff is, forget all that. All I care about, I want to make as much money as possible. I want my 401k to grow as much as possible.
And so I'm going to vote
based upon my 401k.
As Apollo encouraged all of our listeners to do, vote. Right, number one. Which direction do I go? So I'm thinking, okay, the Dems are going to take this, and the Republicans are going to take this, and the Independents are going to get nothing.
Yep. So let's look at let's break it down quickly and into these two different areas. We talked about the White House and Congress, and then let's just take it one at a time, because I think the big contest that is so much on the news, it's about the White House and the presidency. So how will that impact? Because again, if you vote with your wallet, you vote with your dollar bills, and you say, well, I want to vote for what might do better for my wallet. And in that respect, we looked, and I looked personally, because I'm, by the way, I am in the boat that you're in. I want to make money. That's kind of what I want to do. I don't want to lose money. So if I have to pay attention to how will this impact the market. So I went back to 1969, and that's when I'm born. And I wanted to know, in my lifetime, I'm about to turn 55 years old. And in my lifetime, it turns out that the stock market on average annualized about 10% per year. And let's demystify two things. One, the stock market. It's the group of the largest 500 stocks, also known as the S&P 500. That's the metric of the market. And when I say annualized 10% per year, what it means is that if I started with $100, after the first year, I grew that money by 10%, so I would have $110. So then the second year, I start with 110, and I make 10% of that. 10% of 110 is $11. So by the end of the second year, I would have 122. So you keep growing your money at this 10% per year, and you get a sense of what you would have achieved in the U.S. stock market. So let's use that 10% as sort of a yardstick. So let's compare each president's term in office with, and their average and what happened in the market while they're in the White House, and compare with this 10%. And I think that would give you a sense of maybe how to think about the different parties in power and the different presidents' policies that they might bring while they are in charge. So when I was born, President Richard Nixon was in the White House, and he was there for about 5.5 years. And Scott and Pat, during the 5.5 years that he was in the White House, the market did not grow. In fact, it shrunk by about 2.9% per year for 5.5 years. And then his vice president comes along, Jerry Ford, and the market skyrockets for 3.5 years at about 20% per year, 20.2% to be precise. Huge difference, both Republicans, and the market, again, just runs wild. And then Jimmy Carter comes along in 1977, and the market actually does about 11.7, so above average for 4 years while he's in the White House, followed by President Carter, 15.8, and then his vice president 13.9%. So once again, good returns in the market. And then we had President Clinton 17.6% for 8 years. And I know it's not easy to keep track of all these numbers, and I'll come back to this in a second. The reason I'm saying this is because after President Clinton, we had the Bush versus Gore election. President George W. Bush came in, and on average, the market dropped by negative 4.4% per year for 8 years. So at this point, we have two Republican presidents who really had negative returns while they're in the White House, but we also have Republican presidents like like a Jerry Ford, 20%, and then 15.8 for President Reagan. And after that, George W. Bush, President Obama comes along, and his average for 8 years is about 16%, followed by President Trump with a lower return of about 15.2% for one term. And the reason I bring this up is that if you look at all these numbers and if you folks can write them down and look at them afterwards, what you would see is that there's no obvious pattern that would tell you that the market does better or worse during Republicans or Democrats. There's no pattern whatsoever to show you that. The market did well. In fact, all three Democratic presidents had positive returns during their time in office, above average. But some of the best returns came from the Republicans, on the other hand, and some of the worst. So there's no real pattern there. And I hear quite often, well, but one president might come with certain policies, and one president might be better or worse. And I look at President George W. Bush. Look, folks, he was in the White House, and over the 8 years that he was president, the market dropped by over 4% per year on average for 8 years. And one can say he was not a good president for the markets because maybe his policies weren't that market friendly. And here comes the interesting part. When he was president, he actually passed tax breaks specifically towards the stock market, dividends and capital gains. So in that respect, if you saw it and say, look, here's a president that's really promoting tax cuts for stock market, they ought to make the market go up. So what happened? Well, he came in just as the dot-com went bust. How much did he have to do with that? Nothing at all. 9/11 happened 9 months into his term, and he walked off at the bottom of the financial crisis. So should we say that he wasn't a good president for the markets? I don't think that's fair. The same way that perhaps looking at President Clinton with a very high return might not make sense to give him credit because he came in just as Amazon and Pets.com and a lot of these other companies start taking off in the 90s. So in that respect, I think that the narrative, this idea that I want to believe that if a president comes in with certain policies, that's going to be the driver of the market, it does not appear to be the case. Now, you can say that President Reagan, for example, he was all about tax cuts and he was all about growth policies and business, and the market on average went up by 15.8%. And perhaps that's a show of strength for those presidents who come in with those policies. And what I remember, Scott and Pat, is that not long ago, a few years ago by now, when President Obama was running, there was a real concern among certain investors that we have a president that perhaps has more socialist views, and the market is not going to react well. I need to sell and move to Canada because that's a better place. There was that concern that this president doesn't seem to be hyper focused on taxes and business. And what's fascinating is that during the 8 years of the Obama administration, and let's keep in mind, Reagan was 15.8. During the 8 years of the Obama years, the market went up by 16%. How different is 15.8 from 16? It's pretty much identical. So it didn't seem to make that big of a difference for the market. So that's kind of coming back to this idea that there is this notion that I want to believe. And you might be too young, but do you remember the X-Files?
Yes, I do.
Yeah, that was a tagline. I want to believe.
Yes, but
Agents Mulder and Fox, and I think a lot of people, I want to believe that if this president comes in with these policies, that's going to be the main driver of the market. It just doesn't appear to be the case.
Apollo, I think part of the reason is you can't look there. It takes, if you're a big company, you're making long-term investments in order to improve your earnings, right? And
Absolutely.
and it's not, it's not a
Some
2
of these
year
are
or
several
3
years
or,
before
right?
you're expecting a payback.
Right? The multi-decades in many cases, right? And so,
Absolutely.
right? And so it all just kind of, right? Maybe there's a negative correlation, right? Oh, what I do know is if there's a bad market, the likelihood that there's going to be a good market actually improves, right?
Yep.
The worse it gets, the better it's going to get. Right?
The cheaper the prices are, yeah. I mean,
Right? It's going to, anyway, I find it fascinating. I think it is a good reminder to.
My guess is the data for Congress is not just too dissimilar than what it was for the president.
No, and in fact, it gets even more interesting. And by the way, Pat, I so much agree with you because I think we want to find an easy, intuitive explanation. Oh, if this happened, then this must be the case. And I think the world is much more complicated than that, particularly the investment world. So those simplistic ways of looking at it, I don't think they're really productive to investors. But Scott, you mentioned Congress. And I think the issue with looking at Congress and the White House is that when one party controls one part, but the other one doesn't, then you kind of start splitting hairs.
Yeah, and gridlock sometimes gridlock's good.
Exactly. But what I found interesting is that 3 years ago, in 2021, in January, there was a special election in Georgia, and the two Democrats won the Senate races. And at the time when that happened, the Democrats controlled the White House, the Senate, and the House at the same time. So 3 years ago, it just occurred to me that perhaps a more natural experiment would be not to split different ways, the House and the Senate and the White House, but what if you have a way to look at the data when one party was in full control? They had the White House, the Senate, and the House at the same time. So then there's no place to hide. You can make a very clear delineation between the policies of a one party versus the other, and look at how did the market do? And that's exactly what I did 3 years ago. And 3 years ago, when I ran this analysis, going back to 1926, it turns out that the Republicans had full control, the White House, the Senate, and the House. And during these times, it turns out there were 13 years when they had the single party control in DC. When you just take a simple average of these 13 years of returns, what you find is that the markets, the stock market, the S&P, went up on average by about 14.52%. So let's put a pin in that number, 14.52, because we want to compare it with the Democrats. And the Democrats also had this single party unified government control, but instead of 13 years, interestingly enough, they had it for a lot longer, 34 years. So quite a bit longer than the Democrats had this unified government control. And I knew that when I'm going to release that number, people are going to suggest that I'm trying to promote one party or another, one agenda or another. And I'm not doing any of that. It's all about the numbers and what are the numbers saying. And in fact, 3 years ago, I involved the research group, the PhDs in our group, the real smart folks to kind of make sure that my analysis is correct. And it turns out that during the 34 years of the Democratic unified government control, the stock market on average went up by 14.52%.
That's awesome. That is so good. Oh, this is
to the second decimal.
That is
crazy.
That is so good. That is so good.
Unreal.
It is,
and
which, by the way, if you've listened to the podcast for no other reason than that line right there from Apollo, which is, look, it doesn't matter. That's what the headline. Look,
it doesn't matter.
It doesn't matter.
That's right.
It doesn't. Don't call your advisor the day after the elections freaking out, because statistically, it doesn't matter. I don't care if you got a dog in this fight or not. The markets don't care.
Yep.
All right.
And Pat, you're so right. I mean, it is so interesting because what I found is that when you call your advisor and say, I want to get out, it is all emotions.
Oh, it's crazy.
Not data. It's your emotions talking and trying to get the best of you. And that's why you need an advisor from Allworth, because they are a lot more driven by data.
we appreciate that. We appreciate the plug.
But, I've met so many of your advisors. They're phenomenal. I also want to say that when I kind of had that conclusion, somebody kind of said, no, you cannot tell me that this doesn't matter. And it kind of made me think that perhaps this is negating people's reality, saying that, that politics and elections don't matter. And recently, and I think, Scott, when I had the webcast with you, the video interview, I was telling folks the way that I've reframed this in my mind is not necessarily saying that they don't matter. I think politics and elections certainly matters, and to some companies more than others. What I also think, it's one of the many, many, many variables that impacts the earnings of a company and the profits
just one of many.
Of any one stock. And what I found is that it is not a primary variable. It is not one that you can directly link the outcome of an election with how the market's going to do. And the story that I was telling Scott on that video is that when I bake cookies with my daughter, and you put in the eggs, the sugar, the flour, the butter, you mix it all in, you put it in the oven. When the cookie's baked and you break it apart, you can't really point and say, aha, I see the egg yolk in there. No, you can't. It's mixed in with so many other ingredients. It's indistinguishable. And I think that's how I want you to think about the election and politics. It is the egg yolk in a cookie.
That's perfect.
It's something that it's baked in there, but it's not really distinguishable. And the good news, it's not the garlic in a cookie. It doesn't stink it up enough that you can recognize it. But I would not place a trade, and I would not try to disentangle and say, aha, let me find out where that egg yolk is. No, it's baked in. There are other more important variables, but by the end, you put them all in together. This is one of the many, many, many variables that drives the market and any one particular company. I just don't think, and our view is that it's not a good idea to react to politics and emotions, because it's most likely emotions, not data.
Yeah, and Apollo, look, I hear this fake news, real news. Who can tell? Who knows, right? Because everyone coming into the political sphere has a bias, whether you want to recognize it or not, including you, all of us, right? We have a bias. And sometimes the bias is apathy.
Well, Apollo, I certainly appreciate you taking some time to be with us today. It's been really helpful.
Oh, thank you very, very much. I've enjoyed this. I enjoyed it. And what did we learn? From this, 14.52%.
Either
it doesn't matter,
or it's a minor variable. There's many other variables that are much more
important.
That's right.
So. That's right. I appreciate your time.
Yeah,
it's great fun talking to you. Thanks for having me.
Fascinating.
Yeah, it reminds. I like when people are complete experts in a particular area. And Apollo certainly. And I was driving with my daughter the other day, and I was listening I put on an opera song. It was this woman singer. It's just her. Spectacular, right? Just the way she can control her voice. And now my 14-year-old daughter, she thinks I'm a little nuts. I'm like, just listen to this. Like, she is the best at her game. Like, in whatever area of life, like when someone's the best at something, it's just pretty exciting. And that's how I feel about listening to Apollo. So it's fun having you on the program.
Perfect.
Today.
And I'd love to have you back after the elections, and then you could make pronostications about what's going to happen to the market.
I would love to.